Hey everyone, how's it going? Hope everyone is well. We're gonna get started in about 30 seconds or so. We'll see who else join and then we'll take it from there. Okay? So today, like I said, we're gonna focus on three topics here, and we're not gonna do too much market update or anything like that. We're just gonna focus on the workshop. We're gonna focus on these three topics here. I'll elaborate with some examples, some live market examples here on the right. But I'll first explain each of the topic, each of the area that we need a little bit more clarification on, and we'll take it from there. All right. So hello, hello. Nice to see a lot of familiar faces. Nice to see you all. So we'll get started once I see enough people in, then we'll proceed forward. All right. So so how is everyone? Everyone, whoever is online, hope everyone is well. And if you guys had a good month of May, good for you guys. And looking forward for this month, June. Every month, beginning of month, I always have a positive attitude towards the month, and that's what I do for the last whole few years. So hope the same for you guys, and hope the best for you and your family during this time. I hope more people are getting vaccine, or different countries are getting vaccine, at least where I'm from, that's happening. So I hope in a few months' time that will be distributed across the world and good for everyone to go back to normal. All right, so let's get started. Okay, I just want to make sure whoever is online on YouTube and on TradingView, if you can see my charts, you can hear me, and you can see my join that I just dribble on right here. If you can see my join and all that, and we're good to go. Okay, so kindly let me know if you can see me and hear me, and we're good to go. All right. Anybody on TradingView can just give me a Y that you can hear me and see my chart. That would be awesome. I just want to make sure on this platform you can hear me and see me. All right. Thank you, thank you, thank you, silly things. Okay, so let's get started with today's price action workshop number 3. This is the third one I'm doing already. So whoever is new, if you've never seen me do this, this is the third one I'm already doing. You can see them from TradingView under stream, or you can go to my YouTube under my playlists. I've done a few of these workshops already. So if you're interested in these are all like almost 2 hour long. So if you're interested in these, welcome to rewatch them whenever you have time. So today I'm going to focus on 3 topics here. So we're going to focus on evolving structures and patterns. So we're going to talk about scale-in trades, and we'll talk about long-term holds. They're going to be rather similar in terms of, so after we talk about scale-in trades, we're going to talk about long-term holds. It's going to work interrelated. But first thing first is evolving structures and patterns. This is going to be more advanced now, right? This is in the third workshop that we're doing. The previous 2 workshops is a little bit more fundamental and basic on price action. But as we get more and more detail into these price action workshop, it's going to be more advanced and more detailed, more requirement for us to work on it. Okay, so if you have any questions, you're welcome to let me know below, and if I see it, I can answer it. But now let's continue, and we'll see how it goes. This should take about an hour and a half most, depending on how I use the time wisely. Um, we'll take it from there. Can you make a video on how you enter trades? I do have a video on that. I will find it right here. It's this video here I will share with you right here, okay? So EMK Gaming, I'll post the link here for you, okay? Sorry, I can. Okay, anyways. Okay, so that's the link for that. So let's continue now. So first thing first, I talk about evolving structures and patterns. What I mean by that is when we look at what I'm gonna do again is I'm gonna give you a few drawing examples, and we'll go into the charts and take a look at a few live examples, okay? So what I mean by evolving structures and patterns, well, we talk about sometimes the patterns are not complete, finishing, correcting, right? You often hear me say, oh, a correction isn't finished, a correction isn't complete. So sometimes we see a correction here. Most of the time we want to see just a simple correction like this, right? A simple kind of a flag correction where we just have an impulse up, we have a correction, and then the price continue going upwards. This is obviously what we like to see, but it doesn't mean that the price is always going to form something that's simple and something that easy. If you notice, every time when I say look for a correction after an impulsive move, well, we wouldn't know what exactly the correction will form, right? Because we haven't seen it form. We're not some we can't predict the future. We won't know how deep or how complex a correction will form. Of course, sometimes like I said, we can wish or we hope that it will be as simple as this, but sometimes it doesn't get that simple. And sometimes the price continue to evolve, continue to correct into a new structures and pattern, meaning that the correction is the same. The correctional phase is the same, but what ends up happening is the price start forming bigger corrections or bigger structures, but the overall correctional period is still there. The previous impulsive phase is there, and the next impulsive phase will happen. Okay, so the nature of the market, the fundamental of price action doesn't change. It just means that the correction goes on into a deeper correction. So I do a most commonly example here. Obviously, there's so many variation of it, but we'll take a look at the live examples low. But we talk about that. After a strong impulsive move up, naturally we're looking for a continuation. But sometimes this continuation doesn't be the only correction that to start taking off. What ends up happening here is the same correction that pushes up. We first formed this kind of a flag correction, which we're used to. Price pushes up. But what ends up happening is after it broke this high, price began to form into a deeper correction. You can see the red drawing is the extension part of the previous correction. So what's happening is price broke the high here, and then we start pushing down, correct, we push down past this previous low, and then we had a reversal impulse, reverse, and then continuation correction and then continue upwards. What ends up happening is all that is telling you that the previous correctional structure or patterns that we saw is not enough to correct the previous impulsive move. So what ends up happening is it's making a bigger structure. And then at the end, you're seeing that two swing highs, two swing lows were forming into more of an expanding structure, but the overall correctional phase is there. It's the same correctional phase, it's a longer, deeper correction. It's not as simple as the original one that we saw, but at the end, after the correctional period is over, we still get the impulse and move to the upside. The overall market does not change. Remember this, the impulse happens, the correctional period happens, the impulsive move happens. So the complexity here is how to look for these evolving structures, how to be prepared for these evolving structures, and what to be aware of when it happens. Okay, so I hope that makes sense, everyone. I'm gonna go into a few live examples of talking about evolving structure. Again, obviously I can't label every single structure as every single pattern because they're all different. They're all somewhat unique in its own. But we'll take a look at a few easier to identify, and then we'll go from there. Okay. My friend, Bitcoin analysis. I'm not doing the analysis today. I did my weekly outlook yesterday. I'm gonna do a market update tomorrow. today is about working on price actions workshop. Okay, so this is strictly on a workshop, free material, free education, but I'm not doing the market update today. Okay, thank you. So let's look at a few examples of evolving structures. Again, I'm just pinpointing a few more easier to see kind of examples. So the best example here, if you guys recall on Aussie CAD, I think there's a few of us catch few of these Aussie CAD run. So let's look at this example right here. Okay. So focusing on this example, this correction alone. So what I'm going to do here is we'll replay everything. So same example here is just that it's mirror back, okay? It's inverse. This example, the one that we draw is a bullish move. The one here is a bearish move, but it is no difference in this case, okay? So let's take a look here. So same impulsive move pushing down, right? This is the same impulsive move pushing down. And then there is a more of a steeper kind of correction. You can see correction kind of pull back like this. So this is the first correction we saw, but this is still a potential entry. So if you enter accordingly, you know, you obviously adjust your stop loss and manage it accordingly. But as we can see, if we kind of replay the price, this is a large impulsive move. This is a correction, but is this correction, will this correction be the one continue downwards? We'll see, right? So you can see price really pushed down right away, but it's not pushing down more. What it ends up happening is it's forming into a deeper correction. You can see the original correction evolved now into a deeper correction like this, and then still go to the downside afterwards, right? This is the impulsive move. This is a correction. This is the next impulsive move. So what I draw here compared to what I point out here basically is the same thing, right? You have an impulsive move up, you have a correction, and it evolves into a bigger correction, but still continue to its desired original direction. Okay, so of course you're going to identify these over and over again in the market, different time frame, it doesn't matter. But what it's telling you is sometimes the correction that we spot is not enough to continue. Now, everything we do is a probability based. Remember, I always talk about probability because that's exactly what's the case here. This correction here, sometimes it will be all it needs to correct and continue, right? We have seen that in the market before where really the momentum is so strong. That's all the correction it needs is just continuation, right? It's just that sometimes on a probability-based level, sometimes this correction isn't enough to be the one that continue, whereas it eventually form into a deeper correction, but still going down to the downside afterwards, just like in this example here. Okay, so when you enter these trades, and this is really important about risk management now, is when we enter these particular trades, we always have it in the back of our mind. This is why we move our stop loss to break even or potentially in some profit, because we understand that such an impulsive move pushing down, yes, there is a probability of this correction to continue, but we also know there is a probability of forming a bigger correction, which is exactly in this case. So when the price from the original correction has already pushed down, it's naturally good to put it into break even, because that way, if the price does form into a deeper correction, at most you're going to be at loss at a break even or a little bit of profit. And that's exactly in this case, if we look at this case a little bit deeper, is after the impulsive move, we have a correction. I enter this correction, we push down, but we notice we didn't break the low, we didn't continue. So that's a good sign from the market that we might be forming bigger correction. And you can see if I didn't move it to break even, or in this case, if I didn't secure 1% profit, you can tell that if I hold on to a trade, I would have taken a full 1% loss just to see the market play out. And that's a really big no-no for me. A big no psychological thing that people need to work on is by moving it to break even, you eliminate loss right here. You eliminate emotional stress because your trade would have worked out if you have maybe a bigger stop loss or if you enter higher. But what it ends up doing is you enter here, you took a one loss, and then you just see the trade play out. That creates so much anxiety and emotional stress, and I wouldn't recommend that. Okay, so first example, right? Evolving structures and patterns. Very simple, right? Price continue to grow into a bigger pattern, but it continues the previous desired direction. Okay. Any question, guys, on this? Any question on this aspect? Feel free to let me know. I'm going to go through a few more examples. Can I do different shape of a flag? I have several videos on that. You just have to search my, you have to go to my training view, you search for bullish flag or bearish flag. I think you can see it here. No, I don't have it, but you can watch it on my YouTube, my friend, if you're looking for more flag structures. I have a bunch of video on that as well, if I can find it. So price action analysis playlist, flag, yeah, in-depth look into continuation correction, bull or bear flag structures. You can watch this video to learn a little bit more. Do I do mentoring? I don't really. I'll forward you some info here, David. I'll forward you some info in YouTube chat. You can take a look. Are these also co-expanding structures? If not, what's the difference? They are co-expanding structures. They're basically just correction that evolve from a original correction into a bigger correction. That's all, right? So the correction, how people label the name, how people call it, it really doesn't matter, right? Remember, Ali, you've been through a bunch of my videos. You understand that when we talk about price action structures and patterns, we always talk about at least few swing highs and few swing lows. So for me, 2 swing highs and 2 swing low classify as a structure. The original structure already fits that plan. It's just that it evolves into a bigger one. That's all. It's not all structures will be into an expanding structure. Sometimes you'll see a structure that has a flag that potentially just evolve into a bigger flag, right? Just evolves into a bigger flag, but still a flag at the end, right? So we can't all label them as expanding structure. Just maybe in this case it is, but other examples they may not, right? So try to what we need to do as traders is to think outside the box more, right? How the correction end up expanding or evolving really doesn't matter, but we need to know that that could be a potential case. That is a probability of the price doing that when after impulsive move. So every correction we see, there's a probability it will work out, and there's also a probability it will become a bigger structure. Okay. So let's look at a few more examples now. So we'll talk about evolving structures. There's a message here. Do you feel that based on price action alone, not the overall pattern in the correction, you can judge a continuation or reversal, for example, tails and close inside, outside? I think that question's a little bit hard to understand, but I think what you mean is, can you judge the price action alone? Well, the price action is correction, right? So that already doesn't, that kind of contradict itself. But I think what you mean is, can you judge if a correction is a reversal or continuation? Well, sure you can, because it based on the previous impulsive move, it based on what kind of patterns and structures that it forms, because this is clearly an impulsive move. This is clearly a continuation correction. This is the next impulsive move, right? So of course we can have a very good understanding of how the price will move. And based on the structures that we are in, they can predict or at least give you a very good probability of catching the next impulsive move, right? So let's move on here to an example. So Euro Kiwi, I want to talk about Euro Kiwi here. So I think this answers your question, Ali, because this is not an expanding structure. Okay, so let's do a replay here. So when we see a structure like this, you can tell that this is a head and shoulder pattern, and this is an impulsive move pushing down. So very sharp impulsive move, and this is pretty much the first kind of a continuation correction it's forming. This to me is a pretty clear kind of a flag or a continuation correction, and this is what we talk about evolving structures now, because this is the first kind of correction, but it may or may not be the one that continue, right? Remember, there's always a probability that this could be the correction to continue and go down, or it can evolve into a bigger structure and then continue downside, right? So when we play out how it works, well, the first move, well, it correct and then it pushes down. But can we broke below this level? Let's see, right? So clearly it hit this bottom here, but it failed to break lower, and then it pretty much just rebounds back, right? And pretty much reverse back. Now, the second thing we want to know now is, well, if we're going to get an evolve continuation correction, well, it can't just be breaking up and then continue down, because then the overall bearish sign is no longer valid, right? So you can see that now what we're seeing now is we're forming another top here, right? And so the structure at the time is this is the structure at the time. So focus on the yellow line, ignore the green line here. This becomes the new structure now. So now we have few swing highs, few swing lows, and push down from the price, continuation correction. I think that's pretty valid to see that this as a correction to go. So you can see that it did pushes down, but it didn't even reach the bottom of this area. So again, that's a sign from the market that we may be getting a deeper correction now. So, and same thing as this area here. Well, if this continues up and then continue up higher, then it invalidates everything we see here, right? So continue to watch. We see that price pretty much at a sharp reversal to the price, and then see if it's going to try to push below this level, and then but it failed to do that again, right? So pretty much, again, it's telling you that the correction isn't going to be over here, even though there's a probability that this is the current correction that we're in, right? So this pushes down, but again, it pushes down, no continuation to push lower. So that's a sign from the market that we're just going to continue to evolve now. Remember, when we evolve the correction is we're connecting the swing highs and lows. Okay, so let's backtrack a little bit. Originally, we talk about when the correction is something like this, when the price is pushing down from here, right? So ignore all this part. When the price is pushing down here, this is the few swing highs and few swing lows. But you can see when price broke all of that swing low, it did not continue with a continuation. So that's a sign from the market that this area here becomes the new low now. So the new low, we need to re-evolve and readjust the structure here. Now we're seeing more of like a parallel channel now instead of a more of a squeezing kind of pattern, or more of like a rising wedge, so to speak. Now we're seeing a little bit more parallel channel, as we can see here, and now price is right back to the top again. So this is very important, because now you can see that there is multiple swing highs, multiple swing low now. So from the original correction that we saw, this is the impulsive move. This was the original correction. This was the first correction we see. This is the second correction we see. Now we're seeing it evolve into a third correction now, which is, in this case, is the one that played out. Okay, so the reason why I brought all this up is sometimes the correction that we think is over is not over, right? I think we all agree on that. Is sometimes we hope, or not hope, like we think based on what we see here from the price, is that we thought this area here would be the one that dropping down, or this is the area that drops down, but neither of the case. It just continued to evolve. So this is something that we need to accept as traders, is that when we look for a correction finish, when we look for a correction completion, sometimes it won't. Sometimes it will continue to correct for a long time before the impulsive move happens. And this is why we always want to make sure that when we look for entries, right? From the previous example on Aussie CAD, we set it to break even or set it to a little bit profit because from this particular trade, it pushed down, but it started reversing. Well, we need to secure profit. We need to move it to break even because we understand that the correction isn't over. And we might be getting a deeper correction, and there's no point holding the original entry because we don't know if this move is going to start flying up. That means that if you hold through a position, you hit your stop loss, or if you don't even use stop loss, it will just continue up and you lose substantially more amount of money. But when the correction completes, this is exactly what happens, right? There's a few cells that I point out. I think there's a few cells I actually personally enter during these ones, and they resulted with a little bit of profit, not too much, right? Because they all bounce back. But when it actually completes the overall correction here, we did get this next impulsive phase to the downside, right? So this is a very good learning curve for all of us when we're not familiar with price action structures, is that when the impulsive move happens, sometimes the price will correct, sometimes it will correct deeper, sometimes it will correct not as deep. We don't know, we can't predict the future, but we understand that there is potentially going to evolve into a bigger structure before the continuation. Okay, so any question here, guys? When you have the impulse move to the downside, do you look for selling opportunity in correction? I do. I mentioned there's a few entries that I talk about in my risk management video. You can welcome to look at these. There's 3 entries that I talk about in the impulsive move market. You can certainly enter while it's in the correction. Now, remember we talk about everything is a double-edged sword, meaning there's pros and cons. Entering here is obviously going to give you maximum risk reward, but it's also the riskiest. Entering at the breakout of a correction is the safest, but it's going to limit your potential profit. The one that I usually go for a correction after breakout, if you can identify a correction after the price has broken out of that larger, higher time frame continuation, then you're potentially entering, I would say, more medium risk, medium reward type of entries. Okay, so feel free to watch that video. You can learn more about that. So let's continue. I'm going a little bit behind schedule, sorry, but I want to get through the evolving structure. So just a few more examples to go through here. This is Cardano. This is Cardano from crypto. So originally, this is the impulsive move pushing up, right? We can see that this is a very, very, very sharp impulsive move, right? We can clearly see this is a massive impulsive move to the downside. And how the price is going to continue reacting, it's a key here. So we push the price up, right? And then originally, this could be the only correction, right? Looks like we break up, we have a correction here, and then we continue to push up, and now it looks like more like a flag or more kind of like a channel, but I would say more as a flag because of this impulse. So a flag correction. So naturally, we think this is going to be continuation, right? But in this case, it did not, because you can see that it continue. It did pushes up, so it pretty much formed into a deeper kind of a flag, but it pushes up, but it failed to break the high. So what ends up happening is it continued to evolve, continue to correct in a sideways consolidation, right? So after, remember, from the previous push up, now from the original correction, it continues to evolve now, right? So let's take a look what will happen. See how much of a sideways consolidation that the price is doing, right? You can see that it is just in a sideways consolidation. So when we look at the overall price, you can see from the original correction, it has continued to evolve, right? But when the correction completes, because the swing highs and low continue to evolve now, so the impulsive move is there, the correctional phase is there, and we see this inverse head and shoulder pattern that leads into a very strong impulsive move to the upside, right? So this can obviously what happens in this area of the crypto market. But if we look at the overall price here, this doesn't change as an impulsive move. This is a correctional phase. It leads to the next impulsive move, right? So this move did happen, and what it happened, and there is some pip or some risk some reward here to be made because the impulse happened. The correction at the time was here. This was the first correction. It evolved into a bigger correction, and within the correction itself, there's going to be more clue from the price. This is an inverse head and shoulder. This is the potential entry. When we break out, this is another potential entry as well. So that shows you that price continues to evolve. We can't be certain if this is the only correction for this overall move and to continue upwards. Certainly there is a probability of this move going to be the one that's continue, but we also need to understand there's a probability of this continue to evolve into a bigger correction before the next up move. Okay. Chart's not clear. Is chart clear for everyone? I just want to make sure. Is the chart clear for everyone in there? It's clear? Good. Okay, so moving on. Let's do one more here on Binance Coin. So Binance Coin, I'm using different examples just to show you that different market, it doesn't matter which market we're looking at, it doesn't matter which time frame this happens. So looking at Binance Coin here, this is the impulsive move pushing up. This was the original correction. So if we really replay back to here, we can tell that at the time, right? At the time, this is a very sharp impulsive move, and this is really the bigger correction that we see. So certainly this correction can be the one that continue upwards, right? So as we play out here, oh, sorry. As we play out here, you can see that this isn't pushing up as aggressive or as impulsive as we want to see. And can this price even reach the previous high? Because we always talk about when the impulsive move happens, obviously it has to break the previous high and then continuation upwards, right? So in this case, it did not. It didn't push up the high. So we know that if we see this more of a consolidation phase, we know that this correction here isn't enough to correct all this bullish move. We might be getting a deeper correction here, which is what in this case. So as we can see, few swing highs and few swing lows. We're getting in more into kind of a pennant, or you can call this a triangle. Really doesn't matter, but because we know that there is a correction here, the previous correction evolved into a bigger kind of correction now, and we have the first impulsive breakout. And this is my entry here, if I recall. I was looking for a correction after breakout, which is always something that in my plan, right? So we finished this kind of a triangle pattern, and we look for a breakout, and we look for a continuation pattern here, right? So impulse, correction, impulse up, right? And this was my entry here, if I recall. And this, again, it shows you that the impulse, the correction, sometimes evolves into a bigger correction, but nothing changes from a price action point of view because the impulse is there, the correction is there, and then the impulsive move is there following afterwards. Okay, so that's something we can learn and continue to do chart work on. And this is why I emphasize on backtesting, doing chart work, because you're going to get more familiar with this kind of patterns. You're going to get familiar with this type of price action. And there's always going to be potential entries here to capitalize on. Okay. So that is evolving structures and patterns. Again, I talk about patterns and sometimes not finished correcting and may need to continue to correct to form a deeper, bigger correction. So there is a few examples here I point out. But of course, they can all be different, right? It's not always going to be the same kind of flag. It's not always going to be the same expanding structures or something like this, right? It's not always going to be the same like this. It can evolve into something different or something that you're unfamiliar with. But eventually, you're going to get a little bit more recognizable because you know that the impulsive move is the same. The next impulsive move is the same. It's the correctional period. It can be different. It can vary. but we all know that the correctional period is the time that it's the hardest to understand or the hardest to grasp, because once you understand uh, a potential correction is finished, catching the impulsive move isn't that hard, right? The impulse happen, correction, impulse, that's the basic understanding of price action. But the correction itself, how to identify or how to understand when it's about to finish is the hardest part. And I always talk about this, even I can admit it myself, is no price action trader can be 100% sure when a correction will finish. Right? I think we all agree on that, because if I can know this correction will be 100% finished and I can predict the next impulsive move fairly, then really there's no point of risk management, right? Because I would just go all in on this trade, knowing that this correction will finish, knowing that there's 100% probability of this next impulsive phase. But that's not the case, right, guys? We want to be at least optimal in this scenario. Is we know just because a correction form, it doesn't 100% lead to the impulse, right? So that's why we still need to have risk management. We still need to have proper entries. We need to have proper stop loss to cut our loss if the trade doesn't work out, and then continue to look for other opportunities. And like in this case here, I want to point out here is that this is a valid entry correction after breakout, and one of my entries I always talk about. But that doesn't mean that this has to be the one that takes off, right? So what happens is if this move doesn't take off, then what does evolving structures tell us? Well, all of this is telling us that this move here isn't the one that's going to play out. All it is pushes down one more time, perhaps even push down to the low here, and then still continue. But all you do is you understand that the correction, the structure is not finished. It evolves into more of into like a channel now, but still continue upside. Okay, so start doing a little bit more on this, start identifying these kind of larger patterns, and start seeing, do you see what I mean here? The original pattern here evolve into a bigger correction and then leads to the next impulsive move. Okay? So that is evolving structures and patterns. So let's talk about the second topic now, guys. So I spent almost 40 minutes there. I spent a little bit more time than I need, but let's talk about scale in trades now. Okay, we talk about scale in trades. You might have heard me talk about scale in trades, or you might have talked about other people talk about scale in trades. But I think there's again, everyone trades differently. Everyone scaling trades differently, or they have different understanding or perspective on it. So I'm going to share what makes sense for me, or what makes sense to do it from a risk management point of view, rather than a profit driven or profit chasing point of view. I think there's a difference in that. A lot of people, when I saw when they scale in, they're scaling in a bunch of trades in the same currency, like 4, 5, 6, 7, of the same entries. I don't want to say that's wrong. Again, there's no right and wrong as long as that fits that person's plan. But I just think that puts a lot of stress, that puts a lot of risk on that trading account by scaling in so many of the same pair and the same entries on the same setup, right? Because if it works out, sure, you'll get profits. But if it doesn't work out, that means you take, 5, 6, 7 losses in a row. I don't really recommend that, especially when you haven't confirm the impulse, or you haven't moved your first trade or second trade into at least break even or in profit. I think there's needed to be strictly management in that sense. Okay, so let's talk about here now. Let's talk about scaling trades now. Is that when I talk about scaling trades, I have specific rules and requirements and what I want to do when I scale in trades. The most important part is making sure your first trade, or the trade before the trade that you're going to take, is at least break even or in 1% profit. So let's take a look at these examples here. Okay, I'm going to go through again different live examples here, but scaling trade opportunities we talk about. So for example, this is kind of the scenario here. So price had a move up and then push down, correct, push down, and then we kind of pull back here and forms into a ascending channel. So now we're getting a little bit more familiar with the price. Remember, we just talked about evolving structures, and this is a prime example here is nice impulsive bullish move up, followed by a reversal impulse, followed by a correction. So is this correction enough to push down the price? In this case, it's not. All it is forming and evolving into a M style pattern here. Okay, remember we talked about M style is all this strong of bullish move. So we have an impulse, correct impulse, and then we fall into a correction here. So this shows you that we're evolving into an M style pattern double top. But let's talk about the scale in entry. So this is getting more familiar with the typical setups that we look for, right? M style pattern. We have ascending channel on the right. We have double top. We have this reversal impulse somewhere there in the ascending channel. So potentially the first potential entry, as I talk about, is the reversal entry. So if you enter at the top here, right, if you enter at the top here, let me just. So if you enter from the top here, this is your first entry, right? This is your first entry potential. And when the move pushes down from the price, when it first form a continuation correction. If you didn't enter from the top here, you can certainly enter at the second part. I think the second part is perfectly fine. If you didn't enter at the top here, you can totally enter at the second time. But let's just say for the sake of this example here, you did enter the first reversal order. Now the price pushes down and it forms into a correction after breakout entry, and you decide to scale in this second entry. Now this is the most important part, is because if I was in the first trade and if I was going to scale in the second trade, I would always make sure the first trade is at least in break even or potentially in 1% profit. Because this way, that even if my second trade doesn't work out, let's say the second trade reverses, then if my first trade is already in 1% profit, then it offside each other, then I'm at break even for two trades. Or if my first trade is already at break even and the second trade I took a loss, then I'm at 1% loss instead of 2% loss of the two trades. Now this all doesn't sound much, but you have to understand when you're trading a larger capital, when you're trading a substantial amount of money, risk management is 101. Risk management is super important because you can't afford like people on Instagram taking multiple entries like this. Okay, it just doesn't make sense on a larger account. On a smaller account where they're trying to double their money, sure, right? I don't want to say that's wrong. But when you have a larger account, when you have a larger capital, naturally you just wouldn't put that much exposure to risk. Okay, you can ask any professional traders out there. It really doesn't make sense to enter multiple positions, especially none of the previous positions is already secure or at least risk free. Okay, so we continue pushing down. This is the second entry. Now we push this down pretty impulsively. We broke this previous low, right? That's always a sign that we broke this previous low, and then we form another consolidation here. So again, that would be another potential scale in entry if you already entered the first or second trade, or maybe you didn't enter the first trade, you entered the second trade as your first trade, then this second potential opportunity here could be your scale in opportunity. So let's say if this is your first trade now and this is your second potential scale in trade, you have a trading plan, you understand we broke the previous low and now the price is consolidating here. Well, certainly you can look for another scale in opportunity somewhere here, right? And that's how you would do it. Again, your first trade now should be at break even or it should be at 1% profit. So your second trade here, even if it goes to the loss, then you're at break even for both trade. Okay, so this is really important. So if this doesn't make sense or it's not clicking, make sure you rewatch it, or you can feel free to ask me questions on this, because this is how you're going to mitigate your losses. Any traders out there can show a bunch of profitable trades, sure, but they're not showing you the trade that they lose. Remember, because they can take a bunch of trades here and they have several trades that went to a loss, but they're only showing you the first profitable trades. But your profitable trades are eaten up by your mediocre trades. So at the end, even though your trade makes, let's say 4%, but you take 3 or 4 more bad trades in the middle, that ends up with a break even anyways, right? So think about what I mean here. Any traders can just enter a trade and get profit, but can they be consistent? Can they mitigate their losing trades? Can they cut down on their losing trades? This is exactly it. Everybody wants to make money in trading, but you also have to understand how to properly make money in these kind of scale-in positions. Okay, so I'm gonna go through a few examples in live market condition, but I just want to point out this as an example. Now, I will not enter when the price is getting very, very, very close to the previous low now. You notice all these entries are fine. The first entry is a reversal entry. The second entry is what I call a correction after breakout. The third entry, I would just say it's a breakout because it broke the previous low and broke from this correction. But as you can see, we're getting very, very close to the previous low. The previous low is rather significant because it was a previous low where it forms a kind of a double bottom and then bullish push up. So this is a very significant area to watch out for. And because we are forming a continuation correction so close to the low, it's just not in my plan to scale in the potential and trade like this where there is not enough to justify like a 3-to-1 risk reward, which is what I always look for in a particular trade. In this case, you can only fit about less than 2-to-1. And this is another good example of how people shouldn't be scaling into this type of scenario where it's really, really close to the previous low. Sure, it has tendency to push down, but a lot of time price is just going to be more corrective pushing down because it's likely to have a reversal. So entering here, you might take a loss. Again, you're eating up your previous profitable trades. Okay, so start thinking about that. If you're looking to scale in positions, scaling accordingly, right? Scaling accordingly so that your first trade is break even, your following trade is on profit, etc. So you don't take unnecessary losses. Okay, so hope that makes sense. Let's go through a few examples of these. Let's talk about a few examples of these. So we talk about dollar yen here. I want to talk about dollar yen here for the price action. We talk about this as a kind of a descending structure here, pushing the price down. The confirmation here for me is the inverse head and shoulder, right? So the inverse head and shoulder is very, very clearly. And I think it's very fine to enter. Someone asked me, is it fine to enter when the price is still correcting? Sure, as long as you forecast the next impulsive move, then entering while the price is in the correction, I think that's totally fine. So in this case, I think it's fine to enter something like this, right? You set an entry order, stop entry order, put the stop loss below, and let the price tag you in. So in this case, price has a very massive bullish push to the upside, right? And the scale in opportunity here, in my opinion, was the first one I saw after the price has broken out of this descending channel, and there is a lower time frame continuation. This was the first entry when price broke out. I think there is a second potential entry here to capture this kind of scale in opportunity. And of course, there is going to be more opportunities in the scenarios. Something like this could be a potential entry, depending on how you like. But you can see this type of entry here, when we're getting so close to the top of the higher time frame structure, right? This is the higher time frame structure when the price is getting so close to the top here. To me, is not a valid scale in entry because you can see this is exactly the same scenario where if you were to enter something like this, price pushes up and then just quickly retrace back down. So you'd be lucky. We'd be lucky if we get a break-even trade. We might even lose some money in this kind of scenario. So when you scaling, make sure you're scaling at the beginning of that impulsive run. You're not scaling at the late end of the impulsive run. Okay. Are most of the correction correct in the parallel channel? Not necessarily, right? Not necessarily. There's so many different corrections, right? So like this correction here, to me, this could be a more slanted head and shoulder. This is a channel. Don't get me wrong, but what I'm saying is, it's not always going to be something like this. It's not always going to be something like this, but if you see more and more and more, it should only build confidence in you because you notice the same thing. You notice that's what the price is doing. You notice that's the nature of the market when there's a consolidation period. The consolidation period is just so clear that sometimes it just forms into a channel that we're always familiar with, right? And that always give you a bit higher probability that leads to the next impulsive phase. Okay, so let's go into Kiwi dollar. So Kiwi dollar, another example here. This is the impulsive phase, right? This is the impulsive phase that we're seeing. We've broken all of that kind of ascending channel structure, and that is the lower time frame continuation. So there's actually a few scenarios where you can actually enter in this impulsive phase. The move happens, right? The move happens down, correct, it happens. But there is, if we dig into the lower time frame, there was a few potential entries, right? Uh, you could potentially enter something like this if it fits your plan, or some people might have entered from the top. And after the price has broken out of the ascending channel, this is certainly another scaling opportunity, or you can classify this as a scaling opportunity, and you're looking for to the previous low or something like this, right? And then we readjust because we're getting to the previous low now. We'll see if the price is going to continue, or we're going to see something like this where it just totally reverts back up. And of course, we manage the trade accordingly. We'll move our stop loss to break even at minimal or into profit in this kind of scenario. Now, more example here on euro dollar scaling opportunity all the way from the top here. Look at this run here. So you can properly forecast or point out that the potential impulsive move will happen. There's actually many entries along the way, right? If we look at the overall price, this impulsive move happens, right? And so this impulsive move has happened, but in the impulsive move, there is many correction in the middle, right? So if you were to enter, let's say if you've spotted this continuation correction after we broke out of this higher time frame kind of wedge, and we're looking for a potential short, if we look into the lower time frame here, this is potentially a correction after breakout. So we impulse out, we correct, right? So you can certainly enter something like this. And because the correction continued to form, there's another correction after we broke this previous low, you can consider entry down here if that fits your plan, or you can enter while we reach the top as a reversal order. But we're looking for the previous low as a potential target, right? The price didn't reach this previous low, unfortunately, in this kind of scenario, but this is the proper scaling when we enter the first position, and when price pull back forming to a deeper correction, and we enter at the second scaling position, making sure our first entry is at least at break even, and got two trades pushing down. And once we start a inverse head and shoulder pattern, potentially this will be your exit point, depending on how you risk or how you manage particular trades. Okay, so always remember in the impulsive phase, there's going to be many correctional period, many small lower time frame correctional period that you can potentially scale into the trade, as long as you understand that your first initial positions should be at least at break even or in profit. So that allows you to scale into the second position or third position, depending on your risk management, to properly do that so you don't put your account at greater risk. Okay. Last example I want to point out is sugar. Sugar, if last year, if you guys recall, all these move up on the price, right? This is the previous high. I always talk about the previous high would be a potential target. So if you look at the overall price, we push up quite a bit here, right? From the original correction, we continue to push this up, and we eventually do reach this previous high here. But if you notice, there are many of these lower time frame correctional phases, and I will not. Sorry guys, let me just zoom out here. For something like this, it's a little bit more tricky because we're getting to this top here, but I think all these entries are valid scale in entries if you got in from the low, right? Because you anticipated of this bullish run to the upside. There is many of these scaling positions. I think all these make sense except the last one because it's getting very close to the top. But all these ones in the middle, if you anticipated or if you already got in on the first initial buy, these scaling positions do look valid to me. Okay. So any questions on scaling trades, scaling opportunities? We talk about the way how we should scale in. We talk about how we should understand risk management. We make sure the previous trade are always in profit or in break even, so we don't put our account at greater risk. Okay. Any questions on scaling opportunities before we jump into long-term holds, which is going to tie into scaling trades, obviously, because when you do long-term holds, you might likely to have a few trades that are running, and that ties into scaling trades because you're likely to have a few trades running because you you scale in a few different scenarios. All right, so that's continue. Let's continue into long-term holds now. So long-term hold, like I mentioned, it ties into scaling trades because of the nature of it, right? Because you're holding a trade for a longer term. But I feel there is a little need more clarification on this topic because I often get questions from people who are saying like, hey, hey Jojo, my trade was in so much profit, but then it reverses and I didn't know what to do. My trade was earning like 2 to 3% or maybe 4%. Now it's back at break even. I hate to see profit goes. Like, what can we do about it? Yeah, let's talk about this a little bit more detail. Again, I'm gonna refer to the double edge thing that I talk about in trading, right? Double edge, right? So good and bad, right? There's always pros and there is always cons. Everything we do in trading. So exactly the same applies to anything we do. So long-term holds is exactly that. So the scenario I brought up about the person uh, upset about their profit get eaten by, well, that's gonna happen from time to time, right? Because there's some trades that you hold that's going to turn out into a good profit because you're holding it. But that means you have to not secure profit. You have to let the trade more room to correct, whatever the case may be, and then continue. So in this case, like if you were to enter here and you move it to break even after it pushes up, and price continue to correct, uh, it didn't peg you out, and then it continue pushes up. So that in that case it works out. But what if it continue? What if it corrects a little bit more slanted, more deeper like this? So by moving your stop loss to break even, it pretty much takes you out here and then just takes out afterwards. That happens too, right? So I just want to bring this out because there's no way of us predicting how the correction will go, right? So you have to understand this when you enter a trade, when you scale in a trade, um, there's just going to be times where you're going to take a break even or you're going to take a loss. What ends up happening, what hurts traders more is when the trade that's in profit falls into a break even. Okay, so there's a few scenarios that I can point out. I'm going to use a few examples later to explain, but let's look at the overall kind of example here I have. Is that when we look at long-term holds is obviously holding the initial trades or scaling trades, right? So we talk about scaling trades, but long-term holds are likely because you're holding, let's say, an initial positions or a scaling positions, and you're looking to hold it through long-term process. Okay. Now you have to understand there's always going to be lower time frame pullbacks, correction, and reversals, right? There's always going to be this part of the price action because there is price action everywhere. Even though you spot a bullish price action on a higher time frame, but the lower time frame will always have bearish price action, right, during the correctional phase before it leads into the next bullish impulsive phase. Okay, so remember this. Higher time frame, you have a bullish bias, sure, but somewhere in the higher time frame impulse or higher time frame correction, there's going to be some sort of bearish lower time frame price action. It's unavoidable, right? Because the price is correcting. If it doesn't form lower time frame price action, the price will just shoot up in a straight line, which doesn't make sense, right? Because we're not seeing any of that in the market. So we understand that these type of lower time frame pullback, correction, or reversals they will happen. And sometimes they will happen to continue the previous move, but sometimes they will happen to reverse, right? We can't be sure, we can't be certain what the correction will form or how the price will develop. Okay, so sometimes you have to understand that. That's the reason why I bring this up, because it's a more psychology thing first. I just want everyone to understand that these things are unavoidable, right? We can't predict the future. When we enter somewhere here, I have no idea what price will form later on. There's no way of you finding out. No one will be able to understand after you enter somewhere here what the price will be after. It's impossible to figure, right? It's impossible to predict. So you just have to accept that sometimes the lower time frame here will just form into a more of a bearish thing and then just start dropping. That's a probability, guys. Or sometimes the lower time frame will form into a deeper correction that may be beneficial for you or may not, because you might scale in here and the trade end up taking you out for a break even or even loss. We don't know, right? So all this is different scenarios that can happen, right? So you just have to first acknowledge that is the case, because we can't predict the future. We can't predict what exactly the correction will form after, because it hasn't even started forming yet, right? So I find a lot of students where they get frustrated because their original entries, it was working well during this time, but then when it starts forming into a deeper correction, they get upset at the market. Well, accept that is the case, okay? Accept that is the market. It doesn't have to go exactly the way you want it to go. If it was that easy, then everybody is millionaire, okay? Everybody is a guru in trading, right? But not everyone is, right? And 95% traders fail in trading. Unfortunately, that is the stat. 95% trader fail in trading, because of this particular reason. They think the market should follow exactly what they think. They think their strategy should play out 100% of the time, but it's not the case, right? So that's the psychology part I want to first bring out to everyone. So it's easier to process things like this, because when it doesn't play out, when the long-term hold doesn't work out, it's just that the market doesn't play out in that fashion. It doesn't mean your analysis is wrong. It doesn't mean your strategy is wrong. It simply just means that this time, this particular case, the market isn't playing out. Okay. My higher time frame is. I think you need to be a lot more detailed. Like I obviously I see what you mean, but there's a lot more to it. Like how big is the correction? How strong is the overall price action? Is there more confirmation of a bearish price action? If I just see an impulse on the lower time frame, to me that's not enough. You need a lot more confluences. You need a lot more multi-time frame analysis. Like the impulse on the lower time frame, is there price action? Is there bearish price action? Double top, ascending channel, head and shoulder. Is there any of that, right? So I know you're just pointing out a particular question, but a lot more information is needed in that case. Okay. So long-term hold. Let's go through a few examples. Let's go through this example here first, and I'll go through a few more examples in the live charts. So I bring this example out because this is one of the scenarios I see a lot. Okay, so pay attention here, because that will help you to see what I mean. Okay, so Rich, let's just say in this scenario, price had this ascending channel, and then we have a really sharp impulsive move to the downside. And let's say previously there is a higher time frame double bottom here. Okay, so you anticipated this is the bottom here of the price. You saw a descending channel here, and you open with a reversal order, right? Reversal order, one of my entry I talk about. So you enter the reversal order. You have very good. You had that very good higher time frame bias of a long. So you're entering at the bottom here, which is great. And you're telling yourself that you might be scaling into a few more positions to the top, and you want to potentially get in on a few scaling positions. So in this case, you scale it, you enter the first trade as a reversal order. Price impulsively pushed up, followed by a lower time frame correction. So again, correction after the breakout now. So even if you didn't enter the first trade, now you might consider entering this as your first trade. So in this example sake, we're going to talk about we enter the first trade as reversal order. We enter the second trade as a correction after breakout. So far so good, right? The price pushes up, pushes up, pushes up. So far to this point here, both trades are running pretty good profit, right? And we're usually traders are pretty happy. But once the trades start falling into a correction, which is in this case, we start getting a little bit doubts now because what was once the profit was up here, now it drops down to here. Okay, now because we scale in the second trades, our first trade is already at break even or potentially at 1% profit, and your second trade is already set to break even because it pushes up more than 1% already, so naturally you will set it to break even. So you can see that when this trade start falling into a correctional period like this, it sometimes create anxiety now for us as traders because we're like, oh no, this is our profit is eaten back by the market. We don't know if this is going to continue go lower. And in this case, let's say that this correction completes and the price is breaking out now. So you think, well, my first trade is already at 1% profit. My second trade is at break even. So I can comfortably enter the third entry now, right? The third as a breakout entry, right? Because this correction finishes. So you set an entry order for the third entry, price tag you in, and we even broke this previous high. So now you're at this level here. This is where the price is. This area is where the price at. So your first trade is in great profit. Your second trade is in very good profit. Your third trade is more than 1-to-1, so you're set it to break even. And you naturally, your second trade probably move up to 1% profit as well. Okay, so I'm doing this example here to show you what was going to happen here in terms of the market here. So first trade, 1-to-1 profit. Second trade, 1-to-1 profit. Third trade, break even. But guess what happens now is price broke this previous high and then reversal impulse, continuation correction, and it pushes down. So guess what happens when this move happens? Not only is your third trade break even take out for break even, your second trade is take out for 1% profit because you move up. And your third trade, whether or not you stay at 1% or you might move it to 2%. If you move it to 2%, then you're stopped out, right? So in total, your first initial trade, you got 2%. Your second trade, you got 1%. And your third trade, you got break even, right? And guess what happens here? And this is one of the things I see the most and I see the traders complain about the most is that after it drops down like this, quickly reverse back, quick, sharp impulse up to the upside, right? So pretty much they always question, well, if I hold through all three trades, if I do whatever, I would have earned this much profit now. And this happens a lot, right? I think everybody will agree sometimes that happens in the market where they see potential trades that are in pretty good profit. The profit was as high as here or as high as here. It end up reversing. So they secure pretty much not much here, right? 2% here, 1% here, and just to see the price reverse back up to their target. Now, I bring this up because this has to do with long-term hold, and this is why having a trading plan, having a risk management is super important because now when this happens, you're going to question yourself, what is your trading plan or how are you going to hold through these type of scenarios? And this is really important now. Again, there's no right and wrong in this kind of scenario because if you didn't do that, if you didn't move your stop loss to profit, you probably cannot scale in the second trade or you probably cannot scale in the third trade without actually protecting your account. But by moving your stop loss into a profit, you kind of choke the price here. You kind of choke the price the first one, you kind of choke the price for the second one. But you know that if you left the trade open, this would have played out. And at least your first and second trade would have played out. Your third trade would have just been break even. But your second trade and your first trade would have been pretty good profit. Okay, so remember I talked about the psychology part when I talk about long-term hold in the beginning. You need to actually write it down what your plan is in this kind of scenarios. There is no better way or the best way to do it. You could do what I mentioned, like by securing a profit, I earn about 3% out of these three potential positions, but I could probably earn more if I didn't move my stop loss in that case. But by not moving up the stop loss, you potentially put your account at greater risk now because the trade itself, sometimes what if this move just drops right back down to here? So not only you took a loss on your third trade, you took a loss on your second trade, you took a break even on your first trade. Okay, so understand there is no right way when it comes to this. You have to manage it accordingly. You might not need to squeeze in too much profit. You can leave everything at break even, right? So you can leave your first trade at break even. You can leave your second trade at break even. In this case, at least your first trade would have still be in. You can still earn this much profit. Your second trade in this scenario would have get taken out for break even. Your third trade would be taken out for break even. But your first initial trade, by holding either at break even or maximum at 1% profit, you secure yourself that potential bullish move to the upside. Okay, so I'm going to give a few examples of live market condition, but I'm bringing this out because this is probably the one that got asked by me quite a bit lately, where students or traders are having a hard time to understand that this can happen, and they're getting pegged off on their the third trade and second trade, and because of that, they exit the first trade because this pushes down. They exit the first trade just to see it reverse back up and realize their first trade would have earned 8%, have if they didn't exit around here. And that creates, again, anxiety and stress, right? That it's the way how the market, the way how the market does to us as traders, right? So have a trading plan, write down exactly what you would do in this type of scenarios, right? What you want to do with your first trade. Do you just move it to break even? Do you move it to 1%? Or do you prefer to secure more profit by moving 2%? There is no right and wrong because I can give you all sorts of scenario where it makes sense to secure more profit, just like I mentioned, or it makes sense to leave it as break even, most of them, because you want to give price room to correct or to move to continue the bullish move. Okay, so understand that what you are as a trader, what suits you as a trader more. Like, do you prefer to leave more room for the price to move? That way, you might not secure as much profit because the price might just take you back at break even, but you also give price enough room for that potential impulsive run. Whereas, would you prefer to secure a little bit more profit, let's say at 1%, 1%? That way, you potentially give price a little bit less room to correct for the next impulsive move, but you also do secure profit here and there. Okay, so understand who you are as a price action trader because that's going to help you to identify which management process, which management approach is suited you as a trader. Remember, you cannot get the best of both worlds. It doesn't make sense. What I mean by best of the both world, well, securing all profit, securing 1%, 2% profit, and expect price to always impulse out. It doesn't, you cannot get the best of both worlds, right? You're either going to secure some profit, but risk of the price taking you out, or not secure profit, risk of taking a break even, but price may give price more room to impulsively out, right? So figure out what makes sense for you, figure out what is more valid for you to take that approach. And of course, you can change your approach or you can modify your approach, modify your trading plan as time goes on. But you need to understand you cannot jump back and forth. You cannot say, okay, well, first trade I should do this, second trade I'll do totally something different. You should stick the same because that's going to work out for you the same, right? You can't just be like, first trade I want to make it um, break even here. Second trade I want to secure 1% profit. Well, you should be relatively the same kind of management approach. Okay. So any question on here? I'm just gonna go through a few live examples of a long-term hold, how I would potentially do it. But I bring this example out because this is one of those scenarios where it will happen, right? Where it will happen where the price does end up tagging you out on your third entry or even your second entry. but it's not likely to hit your first entry, so it really depends on how you plan to manage it. Okay, so do you manage your long-term holds the same as any position you take? Yeah, kind of just explain that. I would manage it the way how I explain it, meaning that the first entry, second entry, third entry, they should all relatively be the similar management approach. Okay, so let's look at a few examples here. Let's look at Kiwi Cat here. So Kiwi Cat here. Now let's do a few examples here because this is the higher time frame run, right? This is a higher time frame impulsive move to the downside. Very clearly, right? We can see that the impulsive move on this happened, and there is many correction here in the middle. So long-term hold, if you successfully understand that when we're at the top of the overall structure, this is a higher time frame ascending channel. This is a ascending channel on a lower time frame. We successfully forecast this potential impulsive run, right? So there is a few scenario, right? When we're doing long-term holds, you're looking at price to see, well, can the price break the first previous low, and can the price reach the second previous low? This is always going to be our target, at least the way how I set targets is first initial target, second initial target, right? So when we talk at long-term hold, there's obviously entry here, there's entry here, there's entry here, there's entry here, there is entry here. So scale in opportunities, right? If you successfully spot the higher time frame impulsive run, there's going to be many lower time frame entries and areas that you can get in potentially. But you can see when we talk about scaling, if you recall, as you get closer and closer to the bottom here, the scale in trade gets less appealing because you're getting relatively close now. Whereas the scale in positions are going to be much promising when it's at the beginning of this impulsive run. Okay, so when you do long-term hold, understand that, let's say you have an entry here, this is your first entry, and you're looking for a second entry here. Right? In this scenario, the price plays out very beautifully. It's just in a sharp impulsive move. So whatever I mentioned about the long-term hold and all these scenarios, it doesn't apply in this scenario, right? It doesn't apply in this case. This is obviously what we like to see every single time, but it doesn't happen every single time as well. Okay, I do want to point this out because there's going to be times where the impulsive move is strong like this, where there is just no deeper pullback, something that where you need to manage it or maybe move up your stop loss or secure some profit in the example I give below. Sometimes the move just happens very sharp and you're able to catch most of it, right? So whereas there's examples where it doesn't happen. So in this case, this is the second example I want to talk about, which is pound CAD. So if we look at the overall price here, this is the potential high here. We form an ascending channel, and we form kind of a impulse down, breaking the ascending channel, and this is the lower time frame continuation. So if you enter here, I don't think there's anything wrong here. Entering here, you're expecting price to potentially hit the low here or something like that, depending on how you want to set your target. But this is exactly it because you see that price pushes down and then correct, because we already pushed down more than 1%, so we set it to break even as always. And price forms into a deeper correction, and you see how it even pushes out past your break even point, right? So if you didn't set your break even, it's going to be in the minus now, or you might be frustrated, you might even manually exit just to see the price push down much more. Okay, so this is pretty similar like the case I bring here, just inverse related, of course, but it shows you that when you plan to have a long-term hold, sometimes this will happen, right? We set it to break even, price is kind of consolidate, push back right to your entry point, so you take a break even, and just to see the price reverse, and all that showing you just kind of forms into an expanding structure, and it pushes down afterwards. This creates a lot of anxiety, right? And this creates a lot of stress. But it's like what I said here when we talk about long-term hold is that You have to accept that is what's going to happen in the market from time to time. There's no way of us anticipating this will happen. There's no way of us predicting this will happen. So setting it to break even or even possibly 1%, whatever fits your plan. In this case, in my opinion, it's a lot more ideal than leaving a trade open, because what hurts traders the most is seeing your trade hit about, let's say, 2.5%, right? This is at the low here, so this is probably around 2.5%. And watching your 2.5% profit go and hit to your 0.5 loss. And a lot of traders will just manually exit here because they get frustrated that, oh my God, I didn't secure my 2.5% profit. Now it looks like the trade is going to continue hitting on my stop loss. I'm going to manually exit my here for a 0.5% loss, and just to see the price play out afterwards, right? So many traders gone through this type of scenarios over and over again, right? Myself included in the beginning of my trading journey. And I would think a lot of traders would also go through something like this. So that's the important part about having that management plan, right? You understand you move it to break even for the sake of your account, not for the sake of your mindset and psychology. You're not doing this because you're not moving it to break even because of other factors. You're doing this because you're protecting your account, you're protecting your emotion as well, because you don't want this to happen. Right? I'd rather take a break even here than manually close it for 0.5% and then see it drop down. I'm fine taking a break even and seeing this drop down. At least I didn't lose anything after seeing something like this. Okay, so it's all perspective in this kind of scenarios. Okay, so like I said, there's sometimes you're going to see really sharp move like this where it's easy to scale in and easy to have a long-term hold. Sometimes you will not, right? Sometimes you'll get this type of scenarios where the correction or the structure evolve or gets bigger. It pegs you off for your entry point just to see a reverse. Okay, so that happens, right? But falling back to what I mentioned, it's all about having a management plan when it comes to how you plan to manage your scaling trades if a bigger, deeper, longer correction happens. Right? Make sure you write it down so you follow it, and you can of course tweak it or change it or modify it according to how your perspective. So sometimes you might be like, well, I rather give price a little bit more room, so I'm happy to set all my scaling trade at break even. That's fine. Or you might be like, well, I want to secure a little bit of profit because I don't want a trade that goes to 3% and up with a break even. So I will move my stop loss to 1%. And that's fine too, as long as that's your plan to manage these kind of scenarios. Okay, so that is long-term hold. Okay, so I hope that makes sense a little bit. I just get asked about this quite often, and I think what I'm trying to say about this whole thing is there is really no a there's no holy grail. There is no one like the best way scenario in this case, because we simply cannot predict this will happen, right? We simply cannot predict that will happen, right? We simply always see at the time when this move pushes down, oh well, we might get a deeper correction here, we might continue to go down. We didn't know the deeper correction can go as deep as something like this. We wouldn't able to forecast it or recognize something like this. And sometimes this will happen, right? Sometimes this will happen. So make peace with yourself and the market, because we cannot catch every single run. There's no possible entries that to catch every single impulsive move either. Okay, so something like this will happen as long as you follow your management plan. It won't be as stressful or it won't be as emotional in this type of example here. Okay. Chart is not clear. Is it not clear for everyone, or is it clear? I think someone asked that before and it's clear for everyone. Do you want to try to refresh it or change your own setting? My quality is at 10 HP right now, actually, for YouTube. You can change your quality on your side as well. Yeah, you can change on your side, okay? So that's it, guys. That is really it for the long-term hold. That's what I want to talk about in terms of management. In terms of, I think it's obviously when the move plays out, it's very simple and straightforward, right? You can slowly add positions. You see when move is very smooth. like this, then your entries, your scale in, your long-term approach, I think there's nothing wrong with that. But only it's when price doesn't form that impulsive run, when the correction gets a little bit bigger or a little bit more deeper, that requires our management approach. Okay. So, any question, guys, on the three topics I talked about today? We talk about the three topic today. So talk about evolving structures and patterns. So let me just summarize everything once again to wrap this up. We talk about evolving structures and patterns. This is the important part where initially what we thought the price action was, it continued to evolve into a bigger, deeper structure. But that doesn't change anything because the impulsive move is the same. The next impulsive move is the same. It's all it is that the correctional period gets deeper or it gets lengthier. But that doesn't change the nature of the market. So sometimes you just have to be aware that a correction sometimes will form into a deeper correction, and that's something we have to get used to or be prepared at least, so that if we enter any positions, once it pushes up, we set it to break even, knowing that this move can happen. And if we don't set it to break even, we will take a loss here and just to see price take off, right? So understand that management is very important. We talk about scaling positions. I talk about scaling positions. Super important to understand risk management because I see too many people on social media posting like entries like these, which is, in my opinion, not sustainable on a bigger, large account. They might have a small account, or or their plan is to double their account. I'm not sure. But if you have a larger account, or if you're trading for some prop firms, that's really not going to be very good for a consistency level. So we talk about when you are scaling entries, make sure your original position is always at break even or a 1% profit, so that your second trade or third trade, even if it went to a loss, your first or your previous position is going to mitigate that loss by canceling each other out, because your 1% profit for your first trade cancels out your second trade 1% loss. Okay, we also talk about scaling positions when we're getting to the lows. We're getting to the lows, or in this case, highs, right? Remember, everything is inverse related, right? If I inverse my chart, everything is the same, right? Everything is the same in terms of evolving structures. Everything is the same in terms of scaling opportunity, right? If we're getting very close to the top now, I wouldn't enter this scaling position because I could not hit 3-to-1 here. And I don't want to enter a trade when we're getting so close to that significant level. And last one we talk about is long-term hold. We talk about there's a few scenarios that can happen. Sometimes the price can just be in a very strong impulsive move. Then we obviously can scale in positions and holding it for longer term. But sometimes the price will form into a deeper correction. So this example here is exactly what I mean by evolving structures, right? Because originally we see a push up followed by this kind of a flag correction, and that's kind of something like this, but it ends up evolving into a bigger correction exactly like that. So when it evolves into a bigger correction, when you have a several trade that's already in, it's very important to manage it accordingly, because there is pros and cons in whatever you do. If you if you give price room to room, so you put everything in break even, then you might just end up everything in break even, because your third trade is in break even, your second entry is in break even, and your first trade, without putting in a break even, give price enough room to continue the price, right? But your second and third trade are out for break even. Whereas if you do secure a little bit more profit, let's say your first trade is at break even, your second trade is at, sorry, your first trade is at 1% profit, second trade is at 1% profit, and third trade is at break even. When this move pushes down, you're pretty much tagging out for 1% for second trade, and third trade for break even, and your first trade is at 1% or 2%, depending on how you manage it. So you just have to understand when a scenario like this happens, always make sure you move your stop loss and manage it according to your plan. So always make sure you write down in your plan how you want to manage it, how you want to mitigate these kind of situation. Of course, we want to see impulsive move. I always bring this up because um, naturally we want to see impulsive move like this. We want to see impulsive move like this. That's going to help us easier to manage it. But sometimes the price doesn't do that, right? Sometimes this happens where a trade that you were hitting about 2.5% end up with a break even or even a loss if you didn't move it to break even. Okay, so any question here, guys, before I wrap this up? Any question here on everything I talked about today? And if you feel these are good workshop or at least good knowledge for you to hear and see more, let me know that as well. I did, like I said, this is my fourth workshop. So far, I did price action workshop 1, 2. Today is the third one. I did a backtesting workshop. Planning to do a few more of these workshop, of course. But I want to see the overall response from everyone. If it makes sense to them, is it valuable for you to um, hear these and go through these as well? You manage on the time frame you enter, right? Yes, but it also really depending on how the correction will go. So like in this case, if I'm holding the first and second trades, um, obviously depending on how big or how long this correction will go. Sometimes if it's all of this is this part of the correction like this, then sure, whatever the time frame you enter at. But when the correction gets bigger, sometimes you're just not going to be on, let's say, the 15-minute chart anymore. You might be on the 30-minute or even the 1 hour chart, depending on how big this correction will go. God bless you, Jojo. What are you doing is amazing. Forget all the haters. Thanks, brother. Yeah, I've been getting a little bit more haters lately, but that's okay. I don't phase too much by it. So I appreciate you guys who are here to listen to it, or at least uh, here to agree with what I'm saying. I can't change everybody's perspective, of course, right? I can't convince everybody as well, and everybody has their own perspective on things. No haters allowed. Thanks, buddy. Yeah, I think that's about it. Unless there's any questions, these workshop amazing, really amazing. Yeah, I'd love to see more. Great. Yeah, I periodically will do these workshops from time to time. Obviously, depending on the topics and things like that. Uh, I don't really have a course, but you can welcome to go through all my free content on TradingView, YouTube, and things like that. You can welcome to go through all my lessons, educational things on TradingView and YouTube itself as well. Um, in my TradingView, I have quite a bit of things. You just have to find the one that's an educational post. Um, there's usually like something like this education ones. Like there's a lot more of these educational ones out there that I have in TradingView that you can watch or on YouTube. So okay. That's about it, guys. That's about it. That is today's workshop on these three particular topics. Like I said, I do these periodically. If you have any topics or any areas that you want more clarification on, you're welcome to write to me or let me know. I will obviously gather all the information from everybody. I apologize. I can't answer everyone, of course. I can't answer everybody's question as well. I apologize. But I will gather up a bunch of uh, important information or important ones that I feel is necessary to go over, and I will put it into a video. I'll put it into a workshop. I'll put it into an idea, things like that, whether on TradingView or YouTube. That's my way of answering the questions and things like that. Okay. So that is it, boys and girls. So just one question. How do you manage each scaling trade individually? TradingView combine the trades to one trade for me. I personally don't link the broker with TradingView. Of course, you're allowed to, and there's nothing wrong with that. But I personally do everything on my phone. Like I use my phone to enter all my trades. Like it's just easier for me. I've been doing it for years. It's actually I'm just comfortable using it. I open my broker app and I enter, so all my broker will list each different trades individually rather than together. But that's my way of doing it. You can either do it on your phone, or you can just open a web version of your broker, or you can download your MT4 on your desktop and open on desktop as well, right? So that's up to you, of course. All right, everyone. So that is it for me. Tomorrow I will do another market update in New York session. So same time today, 14 o'clock GMT on Wednesday, I will do a market update of the Forex, crypto, indices, and commodities. Okay, so stay tuned for that. But today, that is a wrap for the workshop number 3, and hope to see you guys tomorrow. Hope to see more questions or anything like that from you guys as well, and I can hopefully put into another workshop or another educational video or idea. All right. So thank you very much, guys. Thank you for seeing a lot of familiar faces, and I wish you guys all healthy and happy for the remaining of the week. All right. Thank you very much, guys.